Welcome back to the deep dive. Okay, today, let's get straight into it. We're focusing on the Bitcoin market because, well, it's stuck, really stuck in this tense spot below that critical $110,000 mark.
Yeah, it's like the market's holding its breath.
Exactly. And our mission today isn't just to look at the choppiness. We want to understand this as a market sort of balanced on a fulcrum, right? Weighing that immediate stress against, well, a really big potential long-term shift with regulation.
That's the perfect way to put it. Because the complexity here and what we need to unpack for you is this divergence. You've got wavering institutional conviction. Right now, look at the ETF outflows.
Right, they dipped again.
Yeah, net outflows. And that's colliding, like head on with this potentially massive de-risking event on the horizon, the Clarity Act, the Digital Asset Market Clarity Act of 2025.
So it's really a study in conflating signals, isn't it? Short-term nerves versus long-term hope.
Precisely. Makes for a very interesting analysis right now.
Okay, so let's tackle that short-term stress first, because I think that's what's testing everyone's patience. We're in this proof of conviction phase, mainly bouncing between 108K and 109K. It just can't seem to reclaim $110,000, let alone that $113,000 resistance. Why does it feel so fragile?
Well, I think a big part of it is that the market structure itself has changed. Fundamentally, it's really because derivatives led now.
Meaning options and futures are driving the bus more than spot trading.
Absolutely. And the scale is, frankly, staggering. Aggregated open interest for Bitcoin options, we estimate, now exceeds futures open interest by maybe $40 billion. That much leverage just changes how price reacts.
Okay, so when options dominate like that, what does it actually do to volatility? What does that mean for someone watching the price?
It means we're likely in what's called a short gamma environment. And this is like a really critical concept for you to grasp right now.
Short gamma, okay? Break that down.
And think of it like this. Dealers, the big players, they have significant exposure, often selling puts, betting the price won't crater. To hedge that risk, if the price starts to drop even a little bit,
They have to sell.
They have to sell spot or futures to balance their books, and that selling pressure just amplifies the drop. It makes small dips bigger, especially near those key option strike prices. It's like throwing gasoline on the fire.
Which explains why every dip feels maybe sharper or more dramatic than it should.
It can certainly feel that way.
But we're also seeing weird signals in the trading flow, right?
Where?
The cumulative volume delta,
Yeah.
CVD, suggests bears are selling aggressively.
Yeah, more sell orders hitting the market than buys.
But the price is, kind of stubbornly, holding above that 200-day exponential moving average. So how do we square that? Bearish positioning, but price holding support.
Well, that exact tension is what creates the short squeeze risk.
Yeah.
You see the CVDs showing net selling, meaning bears are building short positions. But because the price is managing to hold that key support, that 200-day EMA area, those shorts become increasingly risky. If that floor holds firm, all those shorts need to cover.
Meaning they have to buy back Bitcoin.
Exactly. And that forced buying can fuel a really sharp sudden rally. It's a coiled spring situation, basically.
So for you tracking this at home, watching the charts, where are those absolute key lines in the sand right now, the levels we need to watch?
Okay, the immediate most critical support zone is roughly $106,500 down to $107,200. That's a confluence, you see, of the 200-day EMA and recent swing lows. Holding that is paramount.
And if we lose that?
If we break below that convincingly, the short-term picture gets quite a bit darker. On the upside, the clear hurdle is reclaiming $113,000. Getting back above that level would basically invalidate this current bearish setup and signal a potential rebound is underway.
Okay, let's shift gears a bit to the institutional side. Because that momentum seems to have hit a pause button. You mentioned the ETF outflows. U.S. spot Bitcoin ETFs saw $101 million walk out the door on Wednesday. Is that just, expected profit-taking or something more concerning?
It's probably a bit of both, but the net outflow definitely signals a return to caution. Institutions that piled in earlier are maybe trimming positions, taking some profits, waiting to see how things shake out. On the macro front, the regulatory front.
That's definitely a headwind for any immediate breakout, isn't it?
Yeah, a significant one, yeah. Hard to push higher when that flow turns negative.
And maybe the clearest sign of this uncertainty is the huge split we're seeing among big industry names on their year-end price targets. There's just no consensus right now.
Absolutely not. It's fascinating, actually. You basically have two camps forming. On one side, you've got, let's call them the realists. Mike Novogratz from Galaxy Digital, for example.
What's his take?
He's calling for a year-end range of maybe $100,000 to $125,000. Pretty tight. And he's explicitly saying a major breakout needs a new catalyst. He actually pointed directly at regulatory clarity, like the Clarity Act.
Interesting. So who's in the other camp? The bulls?
You could call them that. Think Tom Lee from Fundstrat, Arthur Hayes from BitMEX. They're sticking to much higher targets, $200,000, even $250,000.
And their argument is more based on.
More on the macro picture, liquidity, and the historical impact of the halving cycle. They see those as the dominant forces.
But it feels like you can't just ignore the macro stuff Lee and Hayes are pointing to. Why are the realists like Novograd so focused on something specific like the Clarity Act, rather than just relying on the halving cycle eventually kicking in?
Because I think the market's maturing. These larger institutional players, they operate under different rules. They have compliance departments, risk committees. The halving is, well, it's sort of known, maybe priced in to some extent.
Yeah.
What isn't priced in is the ability for truly massive pools of capital pensions, endowments to come in with like full legal and regulatory confidence. That requires clear rules of the road.
And we're seeing products emerge for that kind of investor too, aren't we?
Exactly. You see firms like Gen2 and EDG UK launching things like a 50% capital-protected Bitcoin accumulator. That's not a retail product. That's a structured note for professional investors, for long-term allocators who need built-in risk management. It signals the market is getting more sophisticated.
And speaking of needing a catalyst, the corporate world kind of underscored Novogratz's point recently. Tesla's Q3 earnings came out.
Yeah, record deliveries, but they missed on EPS.
But crucially, zero mention of Bitcoin, right? No update on their holdings, no hints about future digital asset plans.
Nothing. Complete silence on that front, which, removes the potential spark that some people might have been looking for from the corporate side.
So that really does bring us back to the big potential catalyst everyone seems to be watching, the Clarity Act.
The Digital Asset Market Clarity Act of 2025. Yeah, it's passed the House, now it's with the Senate.
And the narrative around it is that this could finally end the whole regulation by enforcement thing that's, frankly, hampered the U.S. crypto industry and pushed projects offshore.
That's the goal. And it represents a really fundamental potential shift. The core idea is to create a clear jurisdictional bright line, mainly between the SEC and the CFTC.
Okay, so how would that line be drawn? What does the SEC do, and what does the CFTC do under this act?
So the SEC's role would be focused on the initial stages, fundraising, token issuance, basically overseeing things that look like traditional securities offering.
Got it. Investment contracts.
Exactly. Then the CFTC gets clear authority over the spot trading markets for digital commodities. This means regulating the exchanges, the brokers, the dealers that handle assets like Bitcoin once they're considered mature.
Okay, mature is the key word there. How does an asset get classified as a mature commodity instead of a security?
There's a specific mechanism called the mature blockchain test. It looks at factors like decentralization. Is there a controlling central party? Is voting power widely spread? Is the network running without depending on a core leadership group?
So if a blockchain network is sufficiently decentralized,
then its native token can transition to being treated as a commodity, falling under the CFTC's oversight. And any platform trading, it would need to register with the CFTC and follow their rules, custody standards, trade surveillance, all that.
and stablecoins, are they covered too?
They're actually handled separately under a different framework called the Genius Act that's more focused on imposing bank-like reserve requirements and audits on stablecoin issuers to prevent, systemic risks like we saw with past collapses.
This whole Clarity Act push, it feels bigger than just financial regulation, almost like a geopolitical move to stop that brain drain of crypto talent and capital leaving the U.S.
Oh, absolutely. Regulatory uncertainty has definitely pushed innovation elsewhere. The Clarity Act is clearly an attempt to reverse that, to build a solid legal foundation and make the U.S., the global hub for digital asset markets.
Clarity usually comes with costs, right? Compliance isn't free.
No, it's not. And that's the other side of the coin. Higher compliance costs will almost certainly trigger consolidation in the industry. It'll favor the larger, better-funded players who can actually afford to meet those stricter registration and surveillance requirements. Smaller shops might struggle.
Okay, so while the suits in D.C. figure out the long-term structure, let's look back under the hood at what the market participants themselves are doing right now. Because the on-chain data seems to show that same kind of internal conflict we've been talking about.
It really does. You see a clear divergence between the main investor groups. Long-term holders, or NTHs folks, holding for over 155 days are actually net distributing right now.
Selling.
Yeah, selling into strength, taking profits, which is, perfectly normal, healthy, de-risking behavior. In a bull market cycle, it's expected.
But the pressure point, the potential trouble spot, seems to be with the newer money.
Exactly. The short-term holders, or STHs, holding less than 155 days, well, in aggregate, they are now holding their coins at an unrealized loss. Their average purchase price is above the current market price.
And that matters because
Because the STH cost basis often acts as a kind of psychological floor. If the price dips significantly below that average cost basis, you start to see not just regular selling, but potentially forced selling, capitulation, people cutting losses.
which defines how deep a shakeout might go.
Precisely. But it also often signals that we're getting closer to forming a market bottom. This whole dynamic, LTH is selling, STH is under pressure. This is what people mean when they talk about climbing the wall of worry.
And the backdrop for all this is pretty shaky too, macro-wise. We've had this 4-week U.S. government shutdown creating an information vacuum, like flying blind.
It really complicates things. No regular data releases on employment, housing starts, etc.
So does that make Friday's CPI report, the Consumer Price Index, even more critical than usual?
Immensely so. Because it's landing in a vacuum, without the usual context from other economic reports, the market is just hypersensitive to it. Any surprise, any deviation from the consensus forecast for inflation could trigger a really outsized reaction.
So expect fireworks around that release.
Definitely expect volatility. High stakes for that one number.
Okay. But on a slightly calmer note, there's a potential positive on the diplomatic front. U.S. and Chinese officials are resuming trade talks.
Yes, starting Friday in Malaysia. High-level talks, Vice Premier He Lifeng, Treasury Secretary Scott Bessent, Trade Rep Jameson Greer. It's an attempt to, quote, restore calm ahead of a potential leaders summit.
And positive news there could help overall risk sentiment.
Absolutely. Any signs of de-escalation or progress could provide a bit of a cushion, maybe dampen some of that potential CPI volatility. It affects all markets, not just crypto.
Okay, so let's try and tie this all together for you listening. The core conflict seems to be this. You have a soft, maybe even stressed, short-term picture, technically weak, on-chain pressure from profit-taking and nervous new buyers.
Right. Battling against a potentially very strong long-term fundamental picture, mainly driven by the promise of regulatory clarity from the Clarity Act.
It's the immediate versus the eventual.
And the next week or so will likely show us which timeline is winning out in the near term.
So here are the crucial signals you need to watch over the next, say, 24 to 48 hours. First, can Bitcoin defend that key $107,000 support zone we talked about? That's job number one.
Critical level.
Second, how does the market react to that U.S. CPI data on Friday? Given the data blackout, watch for overreactions. Third, keep an eye on headlines from the U.S.-China trade talks in Malaysia. Any shift in global risk mood matters. And finally, we need to see a reversal in the fund flows. Watch for a return to net inflows in those U.S. spot Bitcoin ETFs. That would be a strong countersignal to the recent caution.
Definitely need to see that buying pressure return.
Okay, and let's leave you with a final thought to chew on, connecting that age-old scarcity narrative to this new regulatory dawn. Robert Kiyosaki, the Rich Dad, Poor Dad author, he just doubled down on his buying stance.
What did he say?
He warned that with nearly 20 million Bitcoin already mined out of the total 21 million, buying will accelerate. FOMO real. Please do not be late.
Classic Kiyosaki. But the point about scarcity is real.
Right. So the provocative thought is, what happens when you combine that fundamental, unchangeable scarcity with the kind of clear, legally sound, professionalized institutional rails that the Clarity Act aims to build? What does that unlock long-term? Something to think about as we navigate the short-term chop.